All right, so what's going on in the stock market right now? It seems like everybody is freaking out. I'm getting comments almost daily, probably thanks to a lot of what we're seeing in the media, right? Like we're seeing like, if you're thinking about selling your stocks, well, that's actually a good one. If you're thinking about selling your stocks, you might want to think twice. Correct. But there's just a lot of news. Stocks dive, NASDAQ enters into a correction. And so I'm getting a lot of messages about what do I do? Should I continue investing in things like that? So I wanted to address it today. Now, I understand, first of all, what I'm hearing a lot is, Chloe, these are unprecedented times. I'm freaking out because nothing like what's going on in the world today has happened before. And I hear you. I get it. It is a scary time and I'm not immune to that either. However, what I want to show you in today's video is that we've had unprecedented times before. We've dealt with this in the past. No, not this current circumstances, not this exact thing, but we've faced unprecedented times within the last 100 years, and every single time the stock market has recovered. So what I wanted to do today is give you a little bit of context about what's going on, whether or not you should be freaked out, and what you should maybe consider doing based off of what's going on in the world economy right now. So many of you have asked me like, hey Chloe, what are you doing? These are unprecedented times. And guys, I am sticking to the plan. I'm continuing to invest just like I have any other time and any other thing that we've been through, because what you'll see here in a minute is that staying invested, as long as you are diversified, staying invested for the long term is how we end up creating the types of returns that we actually want to see. When we're buying and selling and we're paying attention to the hype and also the despair and the panic, that's when we actually lose money. And as long as you are well diversified and you also have enough time to recover from the market ups and downs, like I'm talking about, you have 10 years before you're planning on accessing this money. You have 20 years, 30 years. I'm 33 years old. I'm not planning on accessing any of my retirement funds until probably my late 50s, maybe earlier. We'll see what happens. But because of that, I've got time to ride the ups and downs in the market, and I'm also properly diversified. I have thousands of stocks inside of my portfolio that cover every single sector of the economy and also cover all the different countries of the world as well. That's why diversification becomes so important. Now, I get that what's happening in the world right now is unprecedented. It is stressful. We have no idea what's going to happen on a day-to-day basis, but I'll also show some unprecedented times here in a minute. But what I want to say is that we have to really focus on what we actually have control over. What we have control over is to pay attention to policy changes so that we can call our representatives when something like the CFPB going down is happening, and we can call and say, hey, I really hope that my representatives are not going to vote towards this, or they're going to fight to make sure this gets reinstated. That's definitely important. But what else is important is protecting your own peace by limiting what you're exposed to, especially when it comes to the financial stuff, but also making sure that you have the basics down. Like you have an emergency fund, you have things in place that if for some reason you had an emergency or you needed to get the freak out of the country, you've got that in place. So I don't think it hurts for, as we're going through this tumultuous time where we're seeing lots of layoffs, both in the tech sector as well as in the federal sector, and there's just a lot of uproar and a lot of uncertainty right now, it does not hurt for you to extend your emergency fund. Even if that means that you need to pause your investing for a little bit to dedicate more to your emergency fund, get it up closer to that 6-month mark instead of just a 3-month emergency fund, that's a useful thing to do. What's not useful is to panic and buy bricks of gold and hoard your money into your bedroom or under your mattress. That's not necessarily going to be helpful, at least in my opinion. Instead, let's focus on what actually is the fear here. And if the fear is that I'm going to have to leave the country, or I'm going to be without a job, or, I just want to make sure that me and my family are safe, then that sounds like you're probably just going to want to have a little extra cash on hand. So if that's the case and that's where the fear is coming from, look at extending your emergency fund a little bit more. So let's get into a few studies to kind of show you the importance of holding on to your investments over the long term and why that's the recommended method. And then we'll also look at what are some other unprecedented times that we faced in history and how did that actually impact your stock market portfolio. So JP Morgan has historically done a lot of these different studies where they wanted to find out if you stayed invested in the S&P 500 over here between 1999 and 2018, which is an almost almost 20-year time frame. They wanted to see what were your likelihoods of, or what were your average annual returns if you stayed invested versus if you missed some of the best days because you were trying to time the best time to get in and the best time to get out. Essentially, you were buying and selling, you were trying to like game the market rather than just being lazy and staying invested. What they found is if you stayed fully invested for this almost 20-year time frame, your average annual return was about 7.96%. But if you miss just the top 10 best days in this 20-year period, your overall returns were cut almost in half and you got a 4.91%. That's just missing 10 of the best days. And here's the thing, we have no idea when the best days of stock market performance are actually going to happen. And so it's really easy if you're timing the market, getting in, getting out, it's easy to miss the best days. And if you just miss 10 of them over a 20-year period, your returns are basically cut in half. If you miss 20 of those days, let's say you're waiting to get into the stock market, you're trying to figure out what the best time is, your overall annual return got cut down to 2%, which is barely keeping up with inflation. So this is why it becomes important for you to stay invested for the long term, because when you're trying to time the market, you're going to miss out on some of the best days, and that's going to impact your overall returns. Now, this is a beefy report that Dalbar Investments firm did in 2022, looking at the quantitative analysis of investor behavior, and it was published in 2023. Basically, what they wanted to look at is the average investor who's trying to buy and sell and figure out the best times to get in. They wanted to compare how they did versus somebody who was super lazy and just stayed invested into something like the S&P 500. What they found, and here for asset allocation, this is somebody who's going to have some bonds and stocks inside of their portfolio, but they're still trying to time the market. And then the average equity fund investor is somebody who's just invested in stocks. So the better comparison here is the S&P 500 with the average equity fund investor, assuming that they're going to be invested in stocks, but they're timing the market. They're trying to figure out the best time to get in, best time to get out because of their emotions. You can see for pretty much all of these different periods, the boring S&P 500, just buying and holding on to it, resulted in better terms for literally all of these, even in the year that the investments were down. So the average buy and hold investor the S&P 500 investor who just held on, they were getting 9.65% average annual returns over the 30 years versus the average equity fund investor who's just buying and selling and trying to figure out the best times to get in. They were only making about 6.81% on average per year. When you look at even the 5-year, it gets even starker, the differences between the average annual returns of just buying and holding on to the S&P 500, 9.42% versus the 5-year average annual return for somebody who's buying and selling, looking at 5%. And then even when we're in a down year, the S&P 500, if you had just bought and held on to it, you would have lost about 18%, whereas somebody who's buying and selling, again, would have lost even more, 3% more. So again, another study to show you, and I'll drop links to all these studies for my nerds who want to dive deeper into it, into the show notes or the video notes. But I just want to show you, like, again, being lazy and staying invested for the long term rather than thinking that you can outsmart the market, which really nobody can outsmart the market. If they do, they just got really lucky. That's basically just taking a gamble. You're going to do better, not only in terms of your return, but also with your stress over the long term. Then finally, there's something that's referred to as the lost decade for equity investors, which equity investors just mean people who are investing in stocks. This is the S&P 500 that we're looking at here, which is just 500 of the largest stocks in the US inside of it. And the lost decade was from about 1999 to about 2010. So this right here, where you can see it's staying relatively flat over this time. And that's because during this time, we had both the dot-com bubble, which we'll talk about here in a second, as well as the great financial crisis of 2008, which, 2008, it led into like almost 2012 before the economy fully recovered. And then if you had stayed invested, so see, you've got flat, 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 flat. But then if you had stayed invested, we then entered into one of the biggest bull runs in history, where we're seeing extreme new heights for the S&P 500. If you had pulled out during this time and didn't stay invested, and instead you waited and you got invested up here in 2022, well, you missed out on the opportunity to get in when it was super low. And the people who just stayed investing, stayed dollar cost averaging, which just means that you're investing money into the market over and over again on a monthly basis, not caring what what the price is, then they would have seen huge benefits now. Like, I wish I had been invested at this time, but I didn't know anything about investing during this time. So this is one of those things where it's like the longer you stay invested, the more likely you are to make money, because again, we never know when bull runs like this are going to happen. And I tell you what, you want to be part of that next bull run when it does happen. Now, something I keep hearing about is, Chloe, these are unprecedented times. And trust me, I hear you. These are unprecedented times. It is freaking weird out there right now. And it's concerning for a variety of different reasons. But what I wanted to do is give you some context for other unprecedented times that have happened in history. And so I just pulled this up on ChatGPT to give us a quick little rundown and summary of the different unprecedented times that have happened within the last 100 years. The Great Depression was within the last 100 years, and when it happened, it was down 86%, which is crazy. It did take about 25 years to recover. This was the worst economic collapse in US history. We had 25% unemployment. We had thousands of banks failing. This was before the FDIC was put into place, and the FDIC was put into place because of the Great Depression and because of the banks failing. We now, keep in mind, we now have the FDIC. The FDIC is now in place to prevent issues like this, to prevent this from happening again. And so we saw insane turmoil in the economy, but we still eventually recovered. Now, I get it, recovering over a 25-year period, that's not great, but even during this time, the stocks did not go down to zero. You did not lose everything that you had necessarily. But yes, you had to take the long term, and you had to stay in it for the long term. Not everybody had that option. Obviously, if you were hitting retirement during these years, that could be devastating to your retirement without a doubt. But this is why it's so important for us to be diversified. So if you're getting closer to those retirement years, then you absolutely need to be prioritizing things like a large emergency fund. You know, generally the recommendation is at least a 2-year emergency fund before you retire, and having diversified investments. You're not going to be 100% invested in the US stock market. You're going to have some bonds, you're going to have some international investments and things like that, so that you have options on where to pull your money out if we were to face an economic collapse to this extent, okay? Now, what else? We also had Black Monday in 1987, where the stock market dropped 22% in a single day. It felt different because it was the biggest one-day percentage drop in history, and a lot of it came from the fear of computer-driven trading that was spiraling out of control. It was just a mass panic, but the market fully recovered within 2 years. And then in the late 1980s and 1990s, again, you saw one of the strongest bull markets ever. This is a common theme, is that it goes down and then often we are shuttled into some really big bull markets, which again, you want to be part of, and that's why it's important to stay invested. Now, the dot-com bubble was a more recent event, which happened in 2000 to 2002. The market dropped 49% for the S&P 500 and 78% for the NASDAQ, which of course would have felt terrible. So we had internet stocks that were skyrocketing to insane valuations, and then they crashed really hard. So we had companies that had no profits that were worth billions, which led to massive bankruptcies, and people thought that tech investing was totally ruined. So it is true that a lot of the companies at the time that were new to the space, that were new because of the advent of the internet, they disappeared. But the market recovered just a few years later in 2006, and the tech sector came back strong as ever, producing some of the giants that we have today, like Amazon, Apple, and Google. Now, a lot of us were around for the 2008 great financial crisis, right? This was definitely unprecedented. The S&P 500 dropped 56%. The US banking system nearly collapsed as well. We had the Lehman Brothers who went bankrupt. Millions lost their homes due to the subprime mortgage crisis. And the government had to bail out banks, which led to widespread fear that our financial system was broken. The market hit rock bottom in March 2009, and then it went on that 10-year bull run that I just showed you. So again, that was part of, like, as it hit the bottom in 2009, immediately after that, we started seeing some wild and crazy returns, and the people who stayed invested benefited from that. Again, I wish I had been invested at that time, but I was like still in high school. I didn't know anything about this stuff. And then even more recently, which all of us can remember, is the 2020 COVID-19 crash. So 34%, we were down 34% in 1 month, and it felt different and unprecedented because we had a global pandemic that shut down literally everything, and we had millions of people who were dying. We were scared travel was never going to return, industries were permanently destroyed, or we were concerned that they were going to be permanently destroyed. So it had its fastest crash in history, falling 30% in just a few weeks. But it also had its fastest recovery in history as well. We had new all-time highs within 5 months, and the stock market grew massively between 2020 and 2021. You guys may have seen like my sharing my net worth updates. 2020 is when I really started investing, and it was in the beginning of 2020. And so I benefited from those stock market increases in 2020 and 2021, but man, do I wish I had gotten in earlier. So I hope this gives you a little bit more perspective. Let me stop sharing my screen to know that like it's going to be okay. I hope it's going to be okay. Based off of history, based off of what we've been through in the past, these unprecedented times, I hope that gives you a little bit more peace. With all of that being said, though, you need to do what's right for you. So if that means beefing up your emergency fund, if that means investing a little bit less, I guess right now, I guess you could do that if you're trying to prioritize investing in your emergency fund. But you've really got to ask yourself, like, why am I pausing on my investments? Is it because I'm going to like buy gold bars or whatever else they're telling you to do on the internet these days? I would question that. I would question whether or not that was the best move for you or not. What I always find that helps is education. At the end of the day, I don't have a crystal ball. I can't tell you exactly what's going to happen, but based off of past events, I have quite a bit of hope that, and quite a bit of belief that we're going to recover from this, that we're going to continue to improve. It may take a while. This administration may burn a lot of things to the ground before we're able to rebuild. And that does scare me, just like it scares everyone else. But I am still investing. I am still doing what I've always done. So what I find that helps with the fear is education. So I hope this gave you some perspective. We do have a free investing class as well that will teach you the ins and outs. It'll go into some of these studies even more in depth, and it'll break it down for you in a way that I think will help you understand exactly why you do want to be invested. And it'll also help you answer some questions in terms of like, well, how do I invest? What are the investments that I should be picking? How do I make sure I'm diversified? I'll leave a link to that down below. That's available at lazyinvestingclass.com. But if you have any questions or have any requests for videos, I'm going to start trying to do this YouTube thing again. Let me know down in the comments, and just remember to keep it chill and build. You've got this, especially if you're investing the lazy way.